broadcast. Please note today's call is being recorded. And now at this time, I'd like to turn things over to Isaac Morris. Please go ahead.
Thank you, Kathy. So again, my name is Isaac Morris, and I'll be the host and one of the presenters today for today's broadcast. Just a few housekeeping issues to take care of before we get started with the presentation. To the extent you need any technology assistance, please call 1-888-569-3848. Again, that's 1-888-569-3848. And if you need any audio assistance, please dial *0. Today's program is going to run for 1 hour, and we will apply for 1 general CLE credit. All New York, New Jersey, and Kansas attendees applying for CLE credit must fill out an attorney affirmation form and write down the course code, and that will be announced later on today during the webcast. Both the attorney affirmation form and today's slides can be obtained in the handout section on the right side of your screen. And questions can be submitted during the web conference by entering them in the Q&A box. And we'll do our best to answer questions during the presentation. To the extent we can't get to them, then we'll follow up by email afterwards. So we have some great topics to cover today. I'll start off the presentation by talking about summary plan descriptions. I'll then turn the time over to Lee Riley, who will be talking about HRAs and FSAs and some new law regarding those. And then finally, Kathy Aizawa will end with talking about year-end amendments. So summary plan descriptions, or SPDs. And as I talk about these slides, some of this information may be a refresher, but I've also tried to add a lot of helpful tips and tricks, some good pointers, and some best practices that we recommend. So hopefully you walk away from this part of the presentation today with not only some reminders and some refreshers, but some additional information that you can take with you. In very general terms, a summary plan description, or SPD, is basically just that. It summarizes the plan's terms and benefits. It talks about any responsibilities the participant or employee may have. It says in part what the plan provides, how it operates, when someone can participate, when and how benefits are paid, how to file a claim for benefits, and other similar items. One of the requirements that is often overlooked, but that's fairly important, is that it needs to be written in a manner your average participant can understand. And for those of you out there kind of groaning right now, I sympathize with that greatly. This is not the easy requirement to comply with, but there are a few things that you can do to help yourself out. One is to use simple declarative sentences. Read through your SPD every few years and think about your employees. And is it describing the plan's terms and benefits in a way that is easy to understand and makes sense? Do you have charts, examples where appropriate to help explain more important and maybe more complex terms? Don't forget to use cross-references, maybe liberally. For instance, when you're talking about the benefits a medical plan provides, it's not a bad idea to have a cross-reference in there to talk about some exclusions to be aware of as well, even if you're just merely pointing out to the participant that they need to be aware exclusions are talked about later on. And in addition, don't forget to not only explain the rules of how your plan operates, but what happens if those rules aren't followed. Time and time again, we come across SPDs where only the first half of that equation is talked about. As a general rule, you need to provide an SPD for any ERISA plan that you have. So for any welfare plan, such as a medical, dental, vision, life, or disability plan, you need to have an SPD. Most of the time, even if your plan is small, only covers a few participants, you still need to have an SPD there. One way that people will try to avoid the 5, 6, or 7 SPDs is to maybe have what's known as a wrap SPD, and that's one situation that can be helpful is if you just want to combine a bunch of SPDs into one document. Nothing wrong with that, perfectly acceptable. Wrap SPDs are also especially helpful in the fully insured context, where the insurance company provides an insurance booklet or a certificate, and you want to take that that document and turn it into an SPD. So you're essentially taking some SPD requirements, which we'll talk about shortly, and adding them in or wrapping them into that document to create a fully compliant SPD. You can also have the SPD and the plan document be one and the same. Again, nothing wrong with that, and that's very common in the medical plan context. One thing to watch out for is if you have an SPD and a plan document that are the same, make sure you don't have a sentence or a description in there saying, hey, this document summarizes the terms of the plan. You want to make it clear that that there's only one document fulfilling both roles. You also need to make sure that if the document that you say is the SPD actually has everything that the SPD requires. And this slide just shows a few of the many requirements of what an SPD needs. I've included a site up there if you ever want to run through everything. It's basically just a giant checklist. A couple of items to be aware of, however. Especially important if you're ever looking at a document and wondering, gosh, is this really the SPD that I have right now? Look for, in particular, these last two items, the claims and appeals procedures and the statement of ERISA rights. Both important in their own right, but can also help be an indicator of whether the document you're looking at is actually the SPD. And then for any welfare plan SPD that you have, don't forget about that first requirement up at the top, Affordable Care Act information. Does your SPD talk about Affordable Care Act provisions to the extent needed? For instance, coming up in 2015, the shared responsibility rules are going into full play. Does your SPD and its eligibility and participation section talk about how you're going to determine hours for employees or determine whether or not somebody's full or part-time? Do you talk about measurement periods or month-to-month? To the extent you're using that information to determine eligibility, you want to make sure that it's included in the SPD. In addition to what has to be included, here's a list of items that we strongly recommend should be included, and I'll touch on each of these just briefly. You want to make sure that you have a sentence or two in the SPD that gives discretionary authority to the plan administrator and any applicable delegate. That gives that person the authority to interpret and administer the terms of the plan, to make any factual determinations. The bullet point about statute of limitations is really just a shorthand way of saying, look, if your plan or SPD has any time limit requirements, such as a certain amount of time to file an appeal or to file a claim in general, make sure those time limits are described in the SPD. Does your document talk about what happens in situations involving benefits that are overpaid or uncashed payments? The non-waiver clause is a reference to situations where you as plan administrator may, for one reason or another, decide not to enforce one particular provision of the plan or SPD. And you're just trying to make it clear to participants that in that instance, it doesn't mean that that provision won't be enforced later on. You also want to make it clear to participants that by agreeing to accept a benefit, or by accepting a benefit, they're agreeing to perform any act or requirement that the plan needs for administrative purposes, such as signing some documents. And then finally, To the extent that you have unique provisions in your plan or recurring situations that keep coming up time and time again, make sure they're in the SPD so that everyone can be on the same page and have notice about that. So what about situations where you change your plan document and that requires a change to the SPD, or where you just change a term of the SPD itself? So maybe you've heard about a summary of material modifications before, or SMMs, and they are essentially formal freestanding amendments to the SPD. They're required whenever there's a material change to the SPD, and determining what is a material change, we go back to our good standby, the facts and circumstances test. I'll give you an easy example of when something is material. For instance, if you're increasing or decreasing the time period under which somebody can file a claim or file an appeal, going from 60 to 90 days. Easier situation there, but you definitely have a material change. For situations that are more gray, we're certainly always willing to help you walk through those situations and determine whether an SMM is needed, or you can always decide to take the safe route and put out the SMM. In a couple of slides, I'll talk about the timeline for when you need to provide an SMM. But as you'll find out if you don't know already, that timeline is extremely generous. And it's not a bad idea, especially when the changes have a big impact, to let participants know ahead of time, even if you're doing it, letting them know about the change on a more informal basis, such as just through a company email or a company newsletter. It's not a bad idea to get the word out sooner. And finally, any interim SMMs or freestanding SMMs are considered part of the SPD, so just be aware of that. If they haven't been incorporated into the SPD, if you're providing the SPD, you need to make sure to provide those SMMs as well. Who's responsible here? Who needs to take care of the SPDs? So the rule is it falls on the plan administrator. That's usually the sponsoring employer, so what that means is that's usually you. It's not the insurance company or the third-party administrator unless they have agreed to take on that responsibility, through a contractual arrangement that they're going to put the SPD together and or distribute it out to who needs to get it. Be aware that unless they've officially taken on the role of plan administrator, that at the end of the day, if there's a problem, the buck is ultimately going to stop with you, even in a contractual arrangement. The other item to be careful about is that when it comes to SPDs provided by or put together by insurance companies or other third parties, we have seen a wide range of the quality and validity of those SPDs. We've seen some that we think are fantastic. We've also seen others that are at the other end of the spectrum and need a lot of work before they can actually even fully comply with all of the requirements. Who do you have to give it to? Who needs to receive it? Well, it depends on what kind of plan we're talking about. For a welfare plan, it's only participants who are actually covered. You don't need to worry about providing a separate SPD to covered beneficiaries such as spouses. For retirement plans, slightly different. You need to give one to each covered participant and then to each beneficiary who's receiving payments under the plan. And then finally, don't forget about special SPD situations such as anyone who's out on COBRA or qualified medical child support orders. Maybe you have a retiree who's still entitled to benefits under the plan, and any recently deceased participants. When do these documents have to go out? I like to think of it as a general rule that anytime someone first becomes eligible under the plan, and then periodically thereafter as the law requires. So send out that SPD whenever a new plan takes effect or, again, when an employee becomes eligible. You can see in the parentheses that there are technically, you have some extended time periods to provide the SPD, but usually there's no reason to wait, so get it out when you can. Otherwise, to the extent that you have any SMMs, you've made some material change, you need to provide the SPD every 5 years. No SMMs, we're looking at you can provide it every 10 years. And finally, you also need to provide it within 30 days after someone makes a written request to receive that SPD. For the SMM, again, going back to that earlier slide, you have a long time to give it out. It's generally within 210 days after the plan year in which the change is adopted. Usually there's no reason to wait till the end of that period. Be aware, it's not on the slide here, but to the extent you have a medical plan and you make a material reduction to any benefits or services, you need to provide that SMM within 60 days afterward. How and where to provide it, these next two slides are probably my favorite part of this presentation, or at least my part of the presentation, because this is where we get the most questions. So again, if you're looking for a general rule, the materials need to be provided by a method that is, quote, reasonably calculated to ensure actual receipt, end quote. And I've listed a few of the acceptable safe harbor methods here. These are safe harbor methods, so that means they're not required. But the great thing about them is that if you follow them or use one of them properly, you're deemed to be compliant with your method of delivery. It's not necessarily a red flag or a huge problem if you stray outside of the safe harbors, again, provided that whatever method you're using is reasonably calculated to ensure actual receipt, and that you're comfortable with any increased scrutiny that you receive from the DOL, the Department of Labor, as a result. So first, acceptable safe harbor methods include both first-class mail or hand delivery, and then probably the most sought after acceptable safe harbor method is electronic distribution. And I've listed the method where no consent is required. The two big requirements that you need to comply with if you want to do that is to make sure that the employee who you're trying to send it to has access to a computer at work. Makes sense. Easy enough. But you also need to make sure that that access is an integral part of the person's work duties. So let me give a couple examples here. If we're dealing with a situation that involves a clerical or a more secretarial type employee, you know, someone who is sitting at his desk the bulk of the day, has access to the computer the whole time, needs to use the computer for his duties, that's a fairly easy situation where you're going to be able to provide the SPD, you know, by email or something similar to that. It gets a little bit more tricky when we start talking about more blue-collar type workers. For instance, a bunch of people who are working on the factory floor. You know, even if those people have access to a computer, you need to examine those situations and determine if that access is an integral part of their jobs. Note that I have not listed, nor am I going to really delve into electronic distribution where consent is required, and that's situations where you can't meet these last two bullet points. Quite frankly, I don't talk about that, and I've never seen someone use it because it's a pain. There's a whole bunch of hoops you have to jump through, a whole bunch of advanced notification, advanced affirmative electronic consent. Anytime I've described those requirements to anyone, you know, I get the feeling that the reaction is a roll of the eyes, and it's just easier to provide an actual hand copy of the SPD. But whatever method that you want to use, consider it carefully. And the reason that I'm saying that is because we have run across situations. I'll give you an example. A few years ago, where we ran across a situation where we did have a bunch of factory workers. And so there was an initial reaction that we weren't going to be able to use electronic delivery. Well, that turned out to be wrong. And what happened is we and the client started doing some additional diligence and discovered that not only did the bulk of these workers have access to a computer, but that access was in fact an integral part of the job duties of those workers. So you can't necessarily jump to one conclusion or the other. You do need to work through them a little bit and find out what's going on. We've also had situations where it's been appropriate to use skinny SPDs. And what I mean by that is situations where we've concluded that we would only be able to distribute the SPDs by mail. But then we look at the SPD, and it's a medical plan / SPD, and it's 125 pages long, and the cost of distribution is astronomical. And what we did in those situations, and we've done this more than once, is we've looked at that document and decided what can we cut out, what can we summarize, and still have it be a fully compliant SPD. And in the situation that I'm thinking about most recent, we were able to take a 125-page document and get it down to about 18 pages. Again, still had to use mail delivery, but made the situation a lot better. Whatever method you decide to use, consider having and following a policy. And you don't need to have a big formal policy about it, but it's good to have some record of what you do and actually what took place in case the DOL ever comes knocking. And I just want to, this is my last slide before I turn it over to Lee, but just want to touch briefly on why you want to be doing all of these things. I think the biggest reason is just to help yourself out. You already have a lot on your plate to deal with. You have a lot of people asking you a lot of different kinds of questions. You want to try to cut down on that where you can. And having a well-written SPD and one that gets delivered should help do that. You know, it's great if someone comes and asks you a question and you can immediately pull out the SPD and point to where the answer is. And I promise you that if you do that a few times, that will start to pass through your employee population. It's also important for litigation. A failure to provide the SPD or a failure to provide all the important terms in that SPD leaves yourself open to someone else interpreting or deciding those plan provisions for you. And I've never seen a court apply or interpret provisions in a way that the employer was entirely happy about. So try to avoid that problem, again, by having a well-written SPD. There are possible penalties that can be imposed. If someone makes that written request for an SPD and doesn't receive it within 30 days, a court can impose a $110 per day penalty for every day thereafter that it isn't provided. Chances are, if someone is arguing for this penalty to be imposed, that there's a whole bunch of other stuff being litigated as well. But again, this one is a penalty that can be easily avoided by providing it properly and then providing it whenever someone makes that request. And just finally, we have had the good fortune to never have seen this happen, but technically it is possible for criminal penalties to be imposed. It would have to be an extremely willful and egregious violation, but I didn't want to not have it on the slide and have someone call me out on it. And with that, I'm going to turn the time over to Lee to talk about HRAs and FSAs.
Thanks, Isaac. So before we get started, I'm going to warn everybody that over the next 20 minutes or so, we're going to talk about a lot of legal rules around HRAs and FSAs. So you might want to take a deep breath, get up, stretch your legs a little bit before we delve into some minutia here. The reason we're talking about this is because over the last 2 years, I would say, there has been a lot of changes to medical reimbursement accounts and a lot of changes to the rules governing HRAs and FSAs and I just want to make sure everybody is aware of what the current legal requirements are. So before I get into the rules, I want to highlight what are the key differences between an HRA versus an FSA. So an HRA, both of them, just so you know, are intended to reimburse employees for medical expenses that aren't otherwise covered by insurance or the employer's self-insured health plan. That's the basic premise of both. But from there, they do have a lot of differences. So a health reimbursement account can only have employer money in it, no employee contributions. But there is no limit on how much can be contributed to an HRA each year. So an employer could put in $1,000, $5,000, $15,000. No limits other than keeping in mind that an HRA is considered a self-insured health plan, and in the Internal Revenue Code there are discrimination requirements where generally you can't do a better contribution for a highly compensated employee than what you're giving a non-highly. With respect to unused balance in that HRA at the end of the year, there is an unlimited carryover possibility. So it really depends on how the employer wants to design the arrangement. They could say your HRA balance carries over from year to year up until you terminate employment and then it's forfeited. Or they could even design it to say, no, even after you terminate employment, you can have access to your HRA balance until you use it up. As far as being subject to the Affordable Care Act, HRAs start out being subject to the Affordable Care Act, but there's two important exceptions. If it's considered integrated, and we're going to spend quite a bit of time talking about what that means, or if the arrangement is for former employees only. If you are familiar with the Affordable Care Act, you may have heard this time and time again. Plans that cover only former employees, like retiree plans, are exempt from the Affordable Care Act. Now, in contrast, FSAs, which everybody is familiar with, pretty much every employer has these, typically has employee pre-tax money. You can have employer dollars, it is permitted, but fairly rare, to be honest. But there's a cap, an annual cap of $2,500 in combination of employee and employer money. FSAs are subject to what's called a use it or lose it rule, so that generally you've got to use up the balance in the current year. There's two exceptions to that. The 2.5-month grace period, which has been around forever. We have a lot of employers that have that in their plan, and the much newer $500 carryover rule. And we're going to talk about that a little later. Same thing as HRAs, flexible spending accounts start off in general being subject to the Affordable Care Act, but they are exempt if there's either no employer contributions to that FSA, so again, that's the vast majority of FSAs out in the world, or if there are employer contributions, it's in the form of a match, and that employer contribution can't exceed $500. So if you've got that limited type of employer money, you're still exempt from the Affordable Care Act. So going back to HRAs and being subject to the Affordable Care Act, why is this such a big deal? Well, as you're all aware, the Affordable Care Act has all sorts of mandates and prohibitions on group health plans. Main one being group health plan can't have an annual dollar limit on benefits. And the other one we're all familiar with is a group health plan has to pay 100% of preventative care services. So health reimbursement accounts are, by definition, a group health plan. Their goal is to pay for medical care. But because of that, they normally would completely violate the Affordable Care Act. They have inherent in their design an annual dollar limit. How much benefits can I get out of my HRA this year? Well, it's the dollar amount of my account balance. Hence, I have an annual dollar limit. In addition, HRAs don't, that I've ever seen, pay for preventative care at no cost to that account. So when you look at HRAs and you look at their interaction with the Affordable Care Act rules, it looks like you can't even have these things anymore. They violate the law. Fortunately, the government agencies came out and gave us some relief on this issue. And they said, no, you can continue to have HRAs as long as they're integrated. And there's two ways you can be integrated. we'll talk about those in a minute. I want to point out these integration rules are effective January 1, 2014, so not plan year, but January 1, 2014. So any contributions or allocations made January 1, 2014 or later for active employees has to be under some sort of integrated arrangement. Okay, so the first way you can integrate is called minimum value not required. And here's what that means. There's 5 rules. The first one is the employer has to offer some sort of major medical plan to the particular employee. That major medical plan does not, however, have to be a minimum value plan. If you're familiar with the Affordable Care Act, minimum value is the concept that the plan is designed to roughly pay 60% of the claim. So if you've got a major medical plan, which means something other than dental or vision, that is not satisfying the minimum value rules, this is the slide you want to focus on. So you offer that plan to your employee. The employee has to actually enroll in a group health plan, whether it be your plan or it can be a plan of somebody else, like another employer or the spouse's employer. And again, it just needs to be a group plan, doesn't have to satisfy minimum value. That works. But note that I emphasized group health plan on this slide because there is no concept of integrating an HRA with individual coverage. So if the employee goes on the federal marketplace, for example, and buys an individual policy there, that is not considered a group health plan that can be integrated with the HRA. Third requirement is the HRA is going to be limited to those employees who are actually enrolled in that group health plan, again, of the employer or of somebody else. The HRA reimbursements have to be limited to the copays, coinsurance, deductibles, and premiums under that group health coverage. So this, in my mind, is true integration. That HRA is intended to actually work with the group coverage. And the HRA can also reimburse other non-essential health benefits, but that's a very limited category of expenses. The final requirement is that the employee has to be given the opportunity at least once per year and at the time of termination to basically forfeit their HRA balance. This looks like a very odd requirement. I'm sure as I was going along, you were probably saying, okay, I get how the first 4 things deal with, integrating an HRA with group medical coverage. What is the point of this 5th requirement? Well, the reason that government agencies put this in is because if an employee desires to go to the marketplace, buy coverage, and get a subsidy from the government, they would be unable to do so if they have an HRA balance sitting in that account. So the government wants employees to be given the choice. I would rather forfeit my HRA balance because I want to go onto the marketplace, buy coverage, and I think I'm going to qualify for a government subsidy. So we, the employers with these plans, have to be able to accommodate that. The second way you can integrate an HRA is called minimum value required. Pretty much it's the same requirements as the prior slide, except that the coverage the employer is offering and the coverage that the employee is going to be enrolled in now satisfies the minimum value rules. Other than that, it's all the same requirements, except you will see here that there is now no restriction on the types of reimbursements that can be made from this account. So you can have unlimited reimbursements of any type of medical expense if you meet these minimum value integration rules. So as you can see, these new rules are going to create some operational issues that we've all got to think about. Do the terms of our health reimbursement arrangements and the summary plan descriptions describing these arrangements comply with these rules? Do we have all these requirements in there, and are we complying with them? If you're going to allow one of your employees to have an HRA, not because they're enrolled in your coverage, but because they're enrolled in group coverage elsewhere, you now got to have a procedure for confirming that. That employee needs to come in and show you, I'm enrolled in my spouse's employer's coverage. It is or isn't minimum value. You need proof of that so you know that the HRA is valid for that person. And then you also need to have some sort of protocol for this forfeiture rule. I don't think the forfeiture rule, by the way, requires you to basically affirmatively go out and solicit this every year. I don't think once a year you need to send an email to everybody saying, hey, do you want to forfeit your HRA balance? But you certainly do need to make people aware they have that right and tell them how they can go about doing that. So this next slide is really important because this is kind of a confusing and often the question we get a lot about this. Integration is relevant at the time the employer is making that allocation or contribution to the HRA. So if you've got an HRA, for example, where the employer says, I put in $200 every month, then every month that employee needs to be actually enrolled in some sort of group coverage. When the employee stops being enrolled in the group coverage, it doesn't mean they need to forfeit their balance. What it means is you've got to stop making contributions, but they still can access their balance for expenses incurred at a later date. So it's relevant at the time of the contribution, not relevant at the time the expense is incurred. And before moving off HRAs, I just want to remind you that the other way you can be exempt from the Affordable Care Act is if your arrangement is limited to former employees, like a retiree HRA arrangement. Don't worry about integration for those types of arrangements. They're just automatically exempt. But I do want to warn you that it's going to be very important to make sure that your retiree arrangement really looks separate from that active employee arrangement so that you can reasonably take the position this plan is for only retirees. So you want to have separate SPDs, separate plan documents, make them look as separate as possible. Now what happens if we've screwed up? What happens if I have an HRA for an active employee that, say, pays premiums for individual insurance, so doesn't meet these integration requirements? What do I do? Well, the penalty is that you now have a plan that violates the Affordable Care Act, and that carries some very stiff fines. There's a $100 per day tax per affected individual, and that's paid by the plan sponsor. We don't obviously want to do that, so what else can we do? The other way to fix this is to basically report the reimbursement amounts from the HRA as taxable compensation to the employee. By doing this, you basically convert the group health plan reimbursement to a taxable compensation payment, and that gets you out of trouble. Now, switching to the flexible spending accounts, as we all are aware, that if there's unused money, for years we've had this 2.5-month grace period rule, which basically says any expenses you incur in the first 2.5 months of the following plan year, you can use your prior year's balance for that. The $500 carryover rule is a fairly new rule. The IRS came out with it pretty late last year, so late, in fact, that very few of us could even, think about it, much less incorporate it into our arrangements, but it was first available this year. And that rule says up to $500 of unused money can be carried forward into the following year. So essentially what that allows is the employee could have up to $3,000 in their account in the next year, $2,500 that they put in plus the $500 carryover. So when you're trying to decide, do I want to do the grace period, do I want to do the $500 carryover, it's actually a pretty simple comparison. If you're going with the grace period, you can carry over unlimited amounts, but you can only use those amounts for expenses incurred in the first 2.5 months of the year. On the flip side, if you do the $500 carryover, you're limited. You can only carry over $500, but that money can be used for expenses incurred at any point in the whole following plan year. So much more usability, if you will. I want to point out this is an either or. So in your flexible spending account arrangement, you either can allow the grace period or the $500 carryover. You can't have both, nor can you give people the choice. So you, the employer, pick. So once you kind of figure out what you want to do, if you're interested in that $500 carryover, I think the most important thing to think about is how that interacts with your group health plans if you have a high deductible health plan with a health savings account. So bear with me on this. Why is it important to think about that? Well, a health savings account is yet another type of medical expense reimbursement account, but it's available to employees whose sole health coverage is a high deductible health plan. So if I'm enrolled in a high deductible health plan and I have some other medical coverage available to me, I can't contribute or receive employer contributions to a health savings account. A flexible spending account that allows the employee to use the money for any general medical expense is considered a second type of medical coverage that disqualifies that employee from contributing to a health savings account. So an FSA where you can use the money for any type of medical expense is called a general purpose FSA, and again, that disqualifies the employee from having a health savings account. So the scenario that we worry about is an employee who during open enrollment says, I'm going to enroll in a high deductible health plan next year because I want to have a health savings account. I want to make contributions to it, or maybe my employer makes contributions to it on my behalf. I'm not going to enroll in the flexible spending account because I know if I do that, I'm going to screw up my HSA eligibility. Well, then in the meantime, the employer adopts the $500 carryover rule. And let's say I'm that employee and I have $20 of unused money at the end of the year that gets carried over into next year. And now I have $20 in a flexible spending account that I can use at any point during next year. The IRS's view on that is because I can use that $20 at any point next year, I have a second type of health coverage available to me for all of next year, and so I can't have health saving account contributions at all for next year. It doesn't matter if I use up my $20 on January 2nd, I am precluded from having that HSA for all of next year. So a really bad result. How do we deal with that? Well, the IRS has actually given us a lot of choices. You can have that carryover money allocated to something called a limited purpose FSA, which only pays dental or vision expenses. That's fine. You can allow the employee to choose that, or you can mandate that. Or you can allow the employee to forfeit their balance because maybe they're better off to forego that $20 so that they can have those health savings account contributions. So my last slide is just a reminder about the new fees we have, our transitional reinsurance fee, which Kathy's going to talk about in a minute, and the PCORI fee, which was $1 last year and is $2.08 this year. I'm not going to go in the slide in detail. This is just for your reference, but it reminds you of what types of, whether these HRAs and FSAs are subject to these fees or not. And with that, I'll turn it over to Kathy to remind us of some year-end deadlines. Kathy?
Thank you very much, Lee. It's funny, usually this presentation every year is heavily weighted toward retirement plan issues, but this year it seems like the balance is tipping more for health and welfare plans. So I'm actually going to be talking not only about year-end amendments that are required, but also some issues and tasks that are required of sponsors either before the end of this year or soon thereafter. So the first thing I'd like to talk about is this thing called a health plan identifier for large health plans. This is kind of a combination of HIPAA concerns and also healthcare reform. So what exactly is an HPID? Well, it's a standardized, unique identifying number that's given to each large group health plan. And the purpose of this is intended to ease the following problems in HIPAA standard transactions. Because of the difficulty of identifying plans, administrators and people who pay for benefits have a hard time in determining patient eligibility. It's also, do we have the right health plan during the claims processing process? Also the improper routing of transactions, and also the administrative hassle of rejected transaction because of insurance identification errors. They've just contacted the wrong plan. So the deadline is coming up quickly. It's November 5th, 2014 is the deadline for large health plans in order to secure these numbers. And what exactly is a large health plan? Well, it's a plan that provides medical, dental, and vision benefits. It engages in electronic transactions, and it pays more than $5 million of benefits every year. So who has the responsibility of securing these numbers? Well, if it's a fully insured plan, it's the insurance company that must secure the number. But if it's a self-insured plan, then it's the sponsor's responsibility to secure the number. Oftentimes, too, self-insured plans may very well have multiple self-insured arrangements within a single plan. So there you have the option of determining I'm only going to get a single HPID for the entire plan, or maybe it's better to get a separate number for each of the self-insured arrangements. So it would probably be good for this employer to talk with their claims administrator to determine whether or not that administrator would prefer to get a separate ID for tracking purposes for each of the embedded self-insured arrangements. So how do you go about and get this HPID? Well, the CMS has actually built an enterprise portal, and they've tried to make it very user-friendly. So you go to this portal, and then you register in the health insurance oversight system. And after registering in the system, then you select the link for health plan and other entity enumeration system, and you simply follow the prompt. Now, this web page has step-by-step instructions. There are instructional videos and also PowerPoints to guide you through the process. Yesterday, too, it was also announced that the process has been streamlined somewhat and that it's no longer required that the approval of an authorizing officer be obtained before the number is released. The next thing I'd like to talk about is, as Lee had mentioned, healthcare reform's transitional reinsurance fee, that there's a reporting deadline that's coming up very quickly, November 15th. Oh, and at this time, I'd also, for those people looking for continuing education credits, the CLE code is the following: B as in boy, 6, Z as in zebra, D as in dog. So that's the code that you use to get your credit. So exactly what are these transitional reinsurance fees? Well, they're fees that are paid by sponsors of self-insured plans and also insurance companies. And the purpose of these fees, it's a healthcare reform advent, but the fees are then paid to the individual market insurers that are now covering high-risk individuals. So the fees are to help these insurance companies bear the burden of covering high-risk individuals. As I mentioned, the deadline to submit your annual enrollment count is coming up quickly. It's November 15th of 2014. And then the first fee installment actually has to be paid by January 15th of 2015. So exactly how long are these fees required and how much are the fees? Well, the fees apply for 2014 and then also the next 2 calendar years, 2015 and 2016. And it's not an insubstantial amount. In 2014, the fee is actually $63 per covered life. And in 2015, it's going to be $44 per covered life. And in 2016, that amount will be announced later. Also, I understand that people need to have the code for the MCLE credits again. So that code again is E as in boy, 6, D as in zebra, D as in dog. As Lee had mentioned too, there's this notion now that healthcare reform has limited the amount of contributions that can be made to a health FSA. So this is the first amendment deadline in my list. So the amendment can be retroactive back to the first day of the plan year beginning after 2012 or January 1st, 2013 for calendar year plans. And this is kind of unusual because usually the general rule for cafeteria plan amendments is that they have to be prospective. So this is an exception allowing for a retroactive effective date. And this $2,500 limit is actually subject to IRS indexing. In 2014, the limit was not increased, and everybody is waiting for the 2015 limits, which if the IRS follows its normal course, those new limits will be announced before the end of October. So just keep your ears tuned. Also, another amendment that's coming up is the health FSA, the $500 carryover rule, if you want to implement that rule. So again, the deadline by which to amend your plan for the $500 carryover rule is going to be December 31st of 2014. So that's sort of for two purposes. If you wanted to implement the $500 carryover rule for the 2013 plan year, thereby allowing you to use unused contributions at the end of 2013 to be used in 2014. Or similarly, if you would like to use the unused dollars remaining after 2015 to be carried over for the 2016 plan year. And as Lee explained, what this rule does is it allows employees to carry over up to $500 of unused FSA dollars that are determined as of the end of the run-out period for that prior plan year. And as mentioned before, you have to choose between the two rules. You don't get to have both. So you have to choose either the $500 carryover rule or the grace period as an exception to the use it or lose it rule. This is also HIPAA certificates of credible coverage is something that may have slipped your checklist. But actually, because healthcare reform prohibits the use of pre-existing condition exclusions effective for plan years beginning in 2014, that then eliminates the need to distribute HIPAA certificates of credible coverage after 2014. So just as a reminder, it would be helpful to check your plan documents, your SPDs, your COBRA packets, and your employee communications because oftentimes they make reference to these certificates of credible coverage. And also, the certificates are specifically mentioned in the DOL model statement of ERISA rights. So it would be good to delete this reference to these certificates in all of your SPDs. As Isaac had mentioned, shared responsibility from healthcare reform is coming up, and employers are going to have to comply with these requirements beginning in 2015. So now would be just a good time to sort of review your game plan of how you're going to identify your full-time employees and what are your plan's eligibility requirements. Because if you need to tweak your plan to accommodate the shared responsibility, now is the time to make those amendments. They should be made before the end of the year. Also, ERISA plans have to be administered in accordance with the terms of their written terms. And so if you're going to rely on look-back measurement periods or stability periods, you need to write down exactly what those rules are, what is going to be your procedures. And you can keep in mind that group health plans, it's not a requirement that all of its terms be reduced to a single document. It can be in multiple documents. So it may very well be that your shared responsibility protocols could be in a separate document from the rest of the medical plan. Now, this next issue is something that actually bridges both health and welfare plans and also retirement plans. And these are the Windsor Amendments, or the amendments concerning same-sex marriage. All of these amendments are going to be effective back to June 26, 2013, which is the effective date, the date of the decision of the U.S. Supreme Court, which held that Section 3 of the Federal DOMA Act, which defined marriage as a union between a man and a woman, was unconstitutional. So effective for qualified retirement plans, you have until December 31st of this year to amend your plans if necessary to comply with the Windsor decision. Government plans have a little bit more time. They have until the close of the first regular session of the legislative body with the authority to amend the plan that ends after December 31st, 2014. That's the deadline for governmental plans. So when exactly is a Windsor Amendment required? Well, it would be required if your plan defines marriage by referencing Section 3 of the Federal Domestic or DOMA, or defines marriage as an opposite-sex marriage. And again, that is required because Section 3 was declared to be unconstitutional by the U.S. Supreme Court. Now, a Windsor Amendment would not be required if your plan defines spouse in a manner that's not inconsistent with the Windsor decision. And a definition would would be compliant with the Windsor decision. For example, if it simply defines spouse as spouse, a legally married spouse, or a spouse under federal law with no distinction between the different sexes. Even if your definition of spouse is not inconsistent with Windsor, it may very well be helpful if the definition was amended nonetheless, just to clarify that same-sex marriage will be recognized by the plan as a valid marriage. So now we finally get to retirement plans, which in hindsight actually has a pretty short list of issues. For sponsors of 401k safe harbor plans or 401k plans with an automatic contribution feature, you have notice requirements, and the deadline for those notices is coming up quickly. It's December 1st of 2014 for 2015 calendar year plans. So if you're a safe harbor plan and you satisfy the safe harbor by going after the match alternative, to give yourself maximum leeway for 2015, be sure that your safe harbor notice includes a sentence that says the employer reserves the right to reduce or suspend the match during 2015. Because if your notice doesn't include this sentence, then you're precluded from taking those actions in 2015. So the same rule applies also for purposes of retroactive contributions. Now, on the other hand, if your 401k plan has an automatic contribution feature, and by that I mean that all eligible employees will be deemed to defer X% unless they tell you otherwise. That's what I mean by an automatic contribution feature. Your notice has to explain exactly what is that deferral percentage, and also the procedures by which employees must follow if they want to opt out of the deferral arrangement or change the deferral percentage. Also, it would be helpful to provide the deadlines by which to make those elections in order to be effective as of a certain date. Another 401k amendment that's going to be required by the end of 2014 is if you are dealing with certain Roth features. And again, this is a special exception because you can make an amendment by the end of 2014, even though it has a 2013 effective date. So, for example, you could amend your 401k plan to include an in-plan Roth conversion of undistributable pre-tax amounts to an in-plan Roth account. Also, you could adopt a Roth contribution program or accept Roth rollovers from other plans or Roth conversions limited to distributable amounts instead of just undistributable amounts. Also, lastly, don't forget about discretionary amendments. And by discretionary amendments, I mean those amendments that the employer would like to make to the qualified retirement plan that's not a legal requirement. It's not an interim amendment. And the deadline for making discretionary amendments is the last day of the plan year, which includes the effective date. So if you change your plan for something in 2014, you have until the last day of the 2014 plan year by which to sign those discretionary amendments. Also, determination letter deadlines. So this next cycle is going to be for Cycle D, qualified retirement plans. And you have until January 31st of 2015 by which to submit your determination letter application. A Cycle D plan is going to be a plan sponsored by an employer whose EIN ends in either a 4 or a 9. And also all union multi-employer plans are deemed to be Cycle D. So they have to get those determination letter applications in by the end of next January. So here is our contact information. If you think of other questions or have any comments about today's program, please contact one of us and we'd be happy to talk with you. Also, just as a reminder, that a copy of this PowerPoint presentation and a recording of today's webcast will be available on Foley's website within the next 24 to 48 hours. Also, if you wouldn't mind taking a few moments before you leave the conference today to provide us with your feedback, we would really appreciate it. Any comments about today's presentation or future topics that you would like discussed in the next broadcast, that would be terrific. And just thank you very much for joining us today. I see that we have received several questions, but unfortunately we've run out of time, so as Isaac mentioned, we will definitely get back to you by email. And thank you very much.